Thanks for jumping on the call, everybody. Whether you're watching live or YouTube afterwards, thanks for tuning in. We were just getting a number of calls from our clients, again, concerned with the upcoming U.S. elections. So we just thought we would give you the playbook based on history as to what's going on. So let me go to some of the charts here. So chart number one is the chart I showed you in July. And chart number one showed you the history of what the stock markets do based on whether the incumbent was running for a second term or whether it was an open field. And I said it was kind of unclear because Trump has already been president once, and Kamala being the VP there was no Democratic convention. Well, there was a convention, but there was no, she was handpicked like we would do in Canada. So it was a bit of a different playbook, but we can see that if you look from July when we had our call until the election, if the incumbent was running, and again, it doesn't say they win, if they were running, the markets would trend higher. If it was, if we looked at the black, so that was green. If we look at the black line, the markets would move higher, but modestly. And if we looked at open field, so two brand new candidates, the market would trend lower into the election. I said it was unclear because it was two new candidates, but Kamala being a continuation of the current regime, and Trump being someone who we had known was most likely to be the green line. And that's in fact what has happened in the markets. We have trended higher. I want to point out from November to the end of the year, in all three scenarios, the market has trended up after an election. And again, it takes a level of uncertainty out of the market. So I'm going to click down here. This is another slide we had going back to the previous call in July. We said that the history would show that the volatility of the market, there's an index which measures the swings in the market, would trend higher. And we looked at July. And by the way, in July, it was running at 12. And we said it would go higher into November. And lo and behold, we have a volatility index today, or yesterday when I looked, of 19.25. So we've gone from 19 to 12. We've actually seen more volatility this year than in typical years. But notice that you get volatility in November, and then that starts to wane down right after the election. So the swings in the market should abate after the election. You can see this is a chart of mid-July of the S&P 500, and we had our call on July 25th. We had just started to turn down. We ended up with a 9% correction, followed by a rally, followed by a 6% correction. So we have seen some kind of gut wrenching, as exactly what predicted, and we have trended a little bit higher in the markets from July. Not a ton. It feels like a ton when you look at the indexes and the commentators, but we have trended a little bit higher in the markets, which is what our history had predicted. What's going on lately in the market? Polls and prediction markets are signaling a Republican sweep in the election. Polls are pretty close. The interesting thing is you can go to Las Vegas, or you can go to futures contracts, and you can place bets on Harris. You can hedge your bet, you can place bets, and the money is about 60% probability of Trump in terms of where the actual money is going, and the polls are very close. And you wonder, as a Canadian, how is this possible? And I will say from the beginning of this, I don't support either candidate. We've got some family friends and live in Florida now, and they are American and they get to vote, and they said, well, we're not voting because we don't support either candidate. And I would be in that camp. I will pass on a funny story. My grandpa, Jim Elliott, was a conservative. He was a surgeon, and my grandma was a nurse, and he was a conservative and she was a liberal. And they decided in the morning that they were going to cancel each other out. So why bother voting? Well, Grandpa's driving home one day and there's Grandma and lining up to vote. So he had sneaking in her vote. So of course he had to go and vote. But anyway, I would be agnostic. I don't support either candidate, and I'll tell you why. There was a survey of corporate executives, and their number one concern, number one, was don't touch my taxes. So when you have a candidate proposing to raise corporate taxes, and let's be clear, raising taxes is the playbook of the 70s. Whether it's any kind of tax, value-added tax or corporate taxes, it's inflationary. If you look at anyone who's studied economics, if you look at a supply and demand curve, whether it's the end price or during the way, based on the supply and demand, a higher corporate taxes are borne by the corporations, and part of it is passed on. That's just the way economics works. So that was their number one concern about corporate executives. So many of them might be publicly saying that they don't support Trump, but many of them may actually end up voting for him. The number two issue that executives say that they're worried about is more regulation. They don't like regulation. Harris to propose federal ban on corporate price gouging in food and groceries. Again, in Canada, we do the same thing. Every time there's a spike in energy, whoever's in opposition accuses the oil companies of price gouging. CNBC had a research piece last year when food prices had surged, and they looked at the corporate profit margins in the food business, and they found that corporate profit margins were near their lowest level in 10 years, not their highest. So, this business, I think, I don't know if it's just political, but at the end of the day, a whole bunch of new taxes to create a whole bunch of government officials to walk around grocery stores with clipboards, I don't think is money well spent. But again, more corporate regulation is something that executives worry about. Again, I think maybe this is something that concerns me greatly, but Trump's tariff proposals would raise tariff rates to Great Depression era levels. Number one policy is we don't need to raise taxes because we'll raise tariffs. Anyway, the stock market seems to be celebrating no new taxes, which is why the markets have risen. Again, you're investing in stocks, you are investing in something. Earnings are reported after the taxes are paid. So if taxes go up, it hurts our profitability, it hurts our earnings. All things being equal, corporate taxes go up, profits go down. So interesting thing as well, not only have the stock markets gone up, but the bond markets have gone down. Here's a chart showing both long-term bonds as the ETF, exchange-traded funds. We have the long-term bond. So since September 18th, we've had Trump rising in the polls, but we also had a U.S. outsized 0.5% rate cut. Now, typically when the Fed starts cutting, they cut by 1/4. The Fed went 0.5%. Oh, that's great news. Well, so if you had inside information, the US Fed's going to cut rates, you would think, well, let's buy bonds, rates down, bond prices up. In fact, that has not worked because actually, since they've started cutting rates, long-term rates have come up and prices down. Now, why is this happening? Well, ironically, neither party is talking about the deficit. This is not in a campaign, and the worry is that Trump's deficits would be perhaps even worse than the Democrats. And again, when you issue big deficits, you are flooding the market with supply of bonds. And if I told you, and I've used this example before, that the world will be flooded with too much lumber, you'd say, well, lumber prices are going down. If you're running a deficit, you're flooding the market with bonds. The typical buyer of these new bonds are existing bondholders, and they push the price of their other bonds because they sell them. You get a perpetual selling of the bond market. So ironically, yields have started going up, which means that the ability to cut rates is starting to get more and more limiting, because if you cut rates and long rates keep going up with the prospect that inflation will rise, the more you cut, the more it becomes limiting. Now, I've just outlined that the stock market is probably discounting. And one of the reasons we had this call is Canadians are very worried about Donald Trump, and perhaps they should be in Canada. But at the end of the day, the market, is not, if you're in a boxing match, it's the punch you didn't see. The market will not be surprised by either outcome. So at the end of the day, the market is pricing in that either one could win. So you don't get that jab that you didn't see. This is the concern. My concern is not with the election. My concern is with this Magnificent Seven, and the large cap US stocks are now valued at levels that we have not seen in 25 years. And, the more they go up, the more people want them. And we're into a new AI revolution, but we've seen these themes before, and they don't happen all that frequently. But price earnings ratios are a measure of valuation, and the higher you pay, the more dangerous it gets. Historically, the market is traded at 16 times earnings. Historically, the NASDAQ, which does represent better growth prospects, has traded just over 20 times earnings. So the NASDAQ could be trading double what it ought to trade at. Another indicator, Warren Buffett, the famous value investor, looked at the value of the stock market relative to GDP. So the growth relative to the stock market value relative to the size of the economy. Typically, the stock market grows with the economy. You can see in 2000 that outsized peak running where the stock market was approaching 130% of the value of GDP. You can see pre-COVID, we were approaching 200. We corrected back, and we're back to all-time high levels of valuation. So what's going on here? Do we have to worry about everything out there? Should we just go to cash, or should we do something out? Goldman Sachs, so maybe the most highly regarded investment firm in the United States, forecasts just a 3% return for the S&P 500 annual return over the next 10 years. And the last 10 years have produced 13, so why 3? And this is their modeling. And you can see that where they have modeled, this gives you the rolling 10-year numbers. So you can see in 2010, the stock market had a negative 10-year return. Negative 10 years, it's supposed to be best for the long run. So it ending in 2010, if you bought and ended in 2000, you had 20% annualized returns. And then it went from 20 to below 0. So they're modeling right now, and their modeling is very, very close to where it ends it up, is baseline of 3%, possibly at -2, best case scenario at +7, and a baseline of 3. It makes sense, and it makes sense based on the valuation of stocks when you buy stocks, and again, when you look at the best time to buy stocks, it's when the news is terrible. COVID, 09 financial crisis, real estate prices were crashing and banks were failing. Those are good times to invest. When there's nothing to worry about, your 10-year returns are going to be subpar. But do we have to worry as investors? Well, we're having a very, very good year, and we're doing it with a modest exposure to the companies that we're talking about, highly valued. The market capitalization of the largest 10 companies in the S&P 500 relative to the total index at 36%. You can see the outsized percentage in 1990. You can see the outsized percentage in 2000, and we have blown through that. So my argument is these 10 companies are skewing the indexes. And if you buy the index, you're going to have 36% of your portfolio in 10 companies, and you're going to have 64% of your portfolio in 490 companies. It's the 490 companies that we are particularly interested in because nobody is popping these up. The poster child of the last bubble of 2000 was a company called Cisco. Cisco makes the bits and pieces involved in the internet. And, you know, we can see that Cisco was 5.5% of the entire market value. You can see as a percentage of GDP, sorry, not market value, GDP. You can see where NVIDIA is today. And, you know, these are dangerous times. I know NVIDIA's earnings are growing as they have a monopoly on AI chips. As Cisco had a monopoly on all the bits you needed for the internet. Of course, there was a lot of competition. Everyone was beginning to copy, as the same thing is happening with NVIDIA. So at the end of the day, what can we do as investors to not expose ourselves? Again, we're talking about election, and am I worried about the election? No. Am I worried about the valuation of the market? Yes. Am I worried about, is there bargains? Is there places? You know, we have kept clients out of the bond market, and we are in the 4th year in a row where the average bond has lost value. So, okay, you may be making 3 or 4% on the bond. You've lost value. You're coming out near zero. And if you look at any bond funds in the world, you'll see that the 4 to 5 year returns are getting close to zero. Treasury inflation protected securities. If you were a client of mine in the 90s, you know that we had huge exposure. Almost 50% of our client base was in real return bonds. Government of Canada, we call them real return. In the US, they call them TIPS, Treasury inflation protected securities. These are bargains. The yield was running 2 years ago at -1. So people said, well, just give me inflation at 1% below inflation. Well, today you can buy them at 199. And based on history, so we look at the valuation of this stock, the NASDAQ at 43 times earnings, and based on history, it's way, way, way overpriced. Based on history, the average real rate of return since 1900 of the industrialized countries is 0.6. You can buy a 10-year treasury at 199 plus inflation. So if inflation spikes again at 9, you're going to get 11. If inflation is 2, you're going to get 4. The US real return since 1900 has been running at 1.3. 199 is a bargain. I would like you to buy these. We're buying them for clients. And I feel if you need to sell your bond in 2 years' time, you will sell it for more than you paid for it. You know, you could argue that why don't we just buy, if inflation is going to be 2, why don't we just buy a 10-year bond at 4.3? And the problem is when you have inflation spikes, which come with regularity, you never get compensated. And case in point, post-COVID, when the printed money and supply shortages, got the double whammy. U.S. inflation went to 9%. Well, interest rates went to 5.5%. But if you were in a treasury inflation protected security, you wouldn't be making 5.5%. You'd be making 11%. So, you know, the risk in the bond market is always these inflation spikes. These do not have the inflation spike risk whatsoever. So there are places, you know, I don't even have a chart on this because they bring it up every time, but we are buying preferred shares from unbelievably safe companies in Canada, whether it's Enbridge or Fairfax Financial or the life insurance companies, or Trans-Canada Pipeline called TC Energy now, at yields of 7 and trading it at 70 cents on the dollar relative to par. To me, these are unbelievable. And let's lower our expectation for the general levels of the market. But where are there bargains? I can also tell you that Europe is only up 5% for the year. The EFI, which measures the, Europe, Asia, and Far East, EFI, that stock index is up 5% for the year. No bubble there. Europe trades at only 14 times its earnings. You know, the S&P, because of the NASDAQ trading at 43, and by the way, a lot of these companies are on both indexes. So the NASDAQ is even more skewed towards technology, but the S&P is still 35% in technology, which makes it a risky bet at 23 times earnings. But Europe's at 14. Oh, well, you know, you could argue Europe is admired in low growth. Listen, you don't get a bargain unless there's a headline that's negative. And if there's no negative headline, the market becomes risky. So there are places that I'm very excited to put your money. I'm going to go back here for a second. 2 days ago, an interview on BNN with David Rosenberg talking about the prospect of a Trump win. And while he said it's really not a negative for the United States, it's a negative for Canada. And he said if Trump wins, he sees the Canadian dollar going down to a point where it costs us $1.50 to buy a US dollar. We've seen in the last 2 months it go from 132 to buy a US dollar to 139. And he sees it going to 150. Again, those are his words and not mine, but we are quite concerned about Canada, as I've mentioned on some of my other calls. There's a Pavlovian response to Canada to cutting rates, and that is you will see probably a headline in October that real estate activity has picked up. It's a smidge. We're running near 10-year lows of real estate activity. And the Pavlovian response is when the Bank of Canada cut rates, real estate's going to boom. Well, the problem is, as I mentioned, that the 5-year yields, the 10-year yields have not dropped. In fact, they've gone up a smidge. And since the Bank of Canada or the US Fed has started cutting rates, we have not seen any declines in the 5-year mortgage rates. This is RBC, the biggest lender in Canada, 3-year 474, 5-year 474. This has been the same level for months. So we have a problem in Canada, and that problem is in 25 and then 26, we're going to see the greatest rollover of mortgages in history. The problem is that 5 years ago, interest rates were 175. To go to 474 is going to be a 40% increase in your monthly payment. If you're going to go from $3,000 a month, it's $4,200, and that spending has to come from somewhere. A, you're going to default, or B, you're going to tighten your belt and spend a whole lot less on restaurants and travel and all kinds of things. US is not in that position. 92% of their mortgages are 30-year fixed, which means that there's no rate shock unless you move, but that's a voluntary thing. So you decide to move, you're going to get a new mortgage of 6.5. Okay, well, I've budgeted for that, but there's nobody that's going to have that rate shock like they saw in 2009. So again, we're going to worry about, we're going to make sure that we're not in the bubble stocks. There is great valuation. And let's talk about rates going down for a moment, because it's just about every day somebody calls us and said they have a GIC coming due. 1 year ago today, you could buy a GIC 1 year at 6. The 1 year rate from a company that you've never heard of is 3.7. And we're getting the, oh my God, what should I do with my money? So it is a positive for the stock markets because, again, money has to go somewhere. So it isn't all that attractive to buy a GIC at 3.7 when CRA, our partner, is going to take 53% of that away from us and leave you with a rate that it doesn't build any wealth whatsoever. So at the end of the day, preferred shares at 7, Treasury protected securities, utilities. We just bought, we've been buying a company, spinoff from TransCanada Pipeline, the pipelines themselves, Fortis, ATCO. These are companies that yield 4 to 5% and good prospect for dividend increases, stated policy of dividend increases. And so you could buy a GIC at 3.7, or you could get a dividend with a dividend tax credit. These are not bubbles, and this is where we will endeavor to place client capital. So I'm not particularly worried about the overvaluation of the stock market. We did very well between 2000 and 2010, despite the S&P doing zero. Again, these are averages of our clients, but we came out about 10% for our clients that stayed with us and followed the program. And I don't expect any different for the next 10 years, but just be careful of the markets. Again, the playbook, we still have a credit problem in Canada, despite the Bank of Canada cutting. Mortgage rates are anchored around that 4.75 level. I'm sure there's some ones that are less than that if you shop around, but again, this is the benchmark. I still look for a problem coming in 2025. So be careful. Don't buy GICs over your $100,000 limit. We're seeing more and more of these real estate funds that had, there's still commercials for them. 7%, 8% for 10 years. They've never lost money. One by one, they're beginning to gate their funds. It's happening all the time. Gating means we're still paying you 8%, but you can't have your money. We're beginning to see problems of developers, stories of Surrey developers offering to pay not only your mortgage, your maintenance costs, and a free trip if you buy your condo from them. These are kind of things that we saw in the United States pre-US crisis. So be careful in Canada. Just follow these. Don't buy any real estate mortgage funds. Be careful of private lending. These funds that have never had a problem. Well, they really didn't exist into the last recession. So be careful. I still say, we've seen a total dichotomy where TD and BMO are down on the year, and Royal and National are way up. But be careful. The problem starts in 2025. Avoid high interest savings mutual funds. Again, not deposit insured, because the fund itself is only insured for 100. So be careful of these things. So this wraps it up. It's not as in-depth a call. Thanks for your questions. The one question we did have was on rates. The other question we had was on the currency. And I think, again, bias to the downside of Canadian dollar. Rates kind of anchored where they are, despite rate cuts. And we'll find you places to make money that feels like 2000 to me. Thanks again, everyone. If we didn't get to your spot, send us an email on your questions, and we'll drive forward. Thanks again, everyone.